Ladies and gentlemen, I think we are starting our live session now. Today's lesson is ratios. Okay, so we can get started now. All right. Let's see now. Let's see with my technical director where we are. Okay, I hope you are connected. All right. So today we are going to cover on accounting ratios. Okay. How are you, Styles? I can actually see you. You are watching from China, right? So I want to broadcast a lesson. So the lesson is Styles. Papa is around. You can actually come in. You can actually view Papa is on screen, Styles. Okay. Yes. Can you hear me, Styles? That side. Okay. Papa is, you can come and actually, some students online can actually see.
How are you?
Styles.
How are you? How are you, Styles?
is hearing us loudly here. In class. So you can actually invite, Styles, you can invite people to this live broadcast, right? So today I want to teach accounting ratios. All right. So I'll use my board. Maybe let me check with my director on the lighting. Can you, our ITC director, can you improve the lighting in this room so that we are now two people now connected. Okay, that's good. That's great. Styles, with this one, you can also type your name so that I can familiarize myself with the names. Okay. All right. So let's get started. Today, we want to cover on ratios, and the first one is want to cover on profitability ratios. Okay. All right. Profitability ratios. So we have under profitability ratios. I think for the meantime today I'll just cover 3 profitability ratios. Okay, that's fine. So number 1, I'm going to cover what we call the gross margin. Okay, gross margin, the gross margin ratio. Okay, gross margin. Okay, is calculated as follows: gross margin. Okay, let me try to make sure that it's clear this side. Okay. Let's pause it a little bit. Just give me a commercial break, 1 minute, so that we can check the technical issues here. All right. Papa Izzy, can you pause a little bit? Just hold on a little bit. I want to check whether my system is okay this side. Okay, it's appearing upside down. Why is it? Styles, is it clear? Is it clear? Can you see me? Can you see what I'm writing on the board? Let me check with Styles in China. Can you see what I'm writing, Styles? Is it? Oh, it's clear. Oh, wonderful. All right, let me continue. Thank you, Styles. Thank you, Styles. Okay, so gross margin is calculated as follows. We say gross profit, our gross profit, okay, gross profit over our sales figure, okay, gross profit over our sales figure, that's our gross margin. It can actually be calculated as, okay, someone in China is complaining that's not clear. All right, and some are blurred. You cannot see the screen clearly. Okay, maybe you can, the camera can also be pushed closer, right? So that we can actually see. All right, I will be waiting for my technical director to sort the things. All right, then there's what we call gross, the gross margin. The second one is called the gross markup, right? Markup. So you can, maybe you can push the camera closer. Gross markup. Okay, gross markup. It's actually calculated as gross profits. Okay, over our costs of what? Of sales. Okay, that's how we do it. Okay, then we are going to cover what we call the ROS, okay, return on capital employed. Okay, return on capital employed, which is equal to our net profit, okay, net profit over our net profit over our capital employed. Okay, all these are calculated as percentages. Okay, they are calculated as percentages. Okay, so Papa is maybe, can you push the camera close? Push the camera close maybe for the viewers to actually see the screen. Okay, all right, maybe so that they can actually try to see. Okay, so these are our profitability ratios with gross margin, which is gross profit over the sales figure. Then we've got our gross markup, which is gross profit over cost of sales. Then we have our ROS, which is net profit over capital employed. Okay, on liquidity ratio, we have got two that I want to cover today. I think it will improve our screen next time. All right, the first one is the current ratio. Current, okay, ratio. All right. I know Styles in China will send a powerful screen very soon, so don't worry. Our current ratio is equal to our current assets. Okay, current assets. All right, let me help somebody's writing exam tomorrow, so I think that would be good. Current assets over our current liabilities, okay? Over our current what? Liabilities. Then we've got what we call the quick ratio. Quick ratio, okay? Quick ratio is calculated as follows. Our current assets, I'll just put CA minus our stock, which is our inventory, okay? I think this is clear. Our current assets minus our inventory over current liabilities, okay? Over our current what? Liabilities. These are our ratios, okay? But it's not sufficient to just understand the ratios. You are supposed to be in a position to comment the ratios. Okay, I hope you are following. Okay, my technical director, I think, is busy trying to check the chat. So if you have got any technical issue, please, you can use the live chat so that we can actually help you. So I wish you all the best in your exam. Okay, all right. What do you do when you are commenting on these ratios? Let's say our gross margin is 40%. Okay, then our markup is, let's say, 70%. Our ROS, in this case, we need to be in a position to interpret the numbers. Okay, commenting on this one, the more this ratio is closer to 100, the better. Okay, if the ratio is close to 100, it means this is a better ratio. It means our sales are actually, out of the sales that we make, 40% is contributing to our gross profit in this case. Okay, 40% is contributing to our gross profit. Okay, then on return on capital employed, remember you invest money into the business. All right, when you invest money into the business, what you expect at the end of the day is the return on your capital. Okay, that return on your capital is what you call the return, the ROS. Okay, so it's 14%. It means every dollar that you are investing. Okay, let's say for every $100 that you are investing in business, you are actually getting a return of $14. Okay, every $100 that you invest in business, 14%. I'm trying to interpret the 14%. Okay, if you invest $100 in a business and your ROS is 14%, it means that you are getting a return of how much? $14. Every $100 that you're investing, you're getting what? $14. Okay. Then on these ratios, okay, let's say, let me start with the ratio number one. I want to try and interpret for you the liquidity ratio. Let's say the current ratio is 2:3. Okay. What you need to do is to make sure that the ratio is reduced. Let's say it's 12/3. Okay, is reduced to a fraction whereby the denominator is 1. So you are going to reduce this ratio to 3 into 12. That will get what? 4/1. It means if this is our current ratio 4:1, it means that you have got 4 of your current assets to meet 1 current liability. It means this is a highly liquid business. Okay, 4:1. All right, it means you as a business you are liquid, and remember, liquidity is the ability of the business to meet its short-term liabilities. Okay, the ability of the business to meet its short-term what? Liability. We call it the current. We call it the liquidity of the business. So it can be measured using the current ratio or the quick ratio. Okay, then let's move on to quick ratio. Quick ratio, let's say our quick ratio is like this one. Okay, our quick ratio, let's say it's again 4 to, let's say it's a 4:1. It means that we have got four of our current assets excluding stock. Okay, four of our current assets excluding stock to meet one of our liabilities. All right, I think this is very clear. So we're saying quick ratio, there's a difference between the quick ratio and the current ratio, right? Our quick ratio, it excludes the inventory in trying to determine the capability or the capacity of the business to meet its short-term liability. So we are saying we are trying to give you a hard test, like you when you're going to the exam, say, can you go and write the exam without reading? That's a quick ratio test or asset test ratio or a litmus test. We're trying to determine your capacity as a business to meet your short-term liabilities without your stock. Remember, stock is highly illiquid. Okay, it cannot be sold or disposed easily. So what you are supposed to do now is to exclude stock when you want to get into a litmus test of your pocket. Okay, it's about your pocket. When your pocket is broke as a business, it means, remember, cash is the lifeblood of a business. All right, I think this is good to go. So let me summarize and check with the technical director. Say, is it to sort the system? So on our next video, I want to dwell much on the calculation part of it. Where I'll give you a schedule in advance. Then I try to explain every concept. Okay, I think this is very loud and clear. So this is our channel. For those who are writing exams, you need to inbox me. You need to contact me. You need to talk to the ITC director so that everything will be fine. Okay, these are our first lesson, so I think you'll benefit so much. So we're saying today we covered on profitability ratios, we covered on liquidity ratio, mainly on the formula part of it, and a little bit of commenting. Okay, so what we are going to do in our next lesson, we are going to concentrate more on the calculation part of it. We are bringing a schedule, and on that schedule, I want you now to do the computation, the calculation. Remember, it's very critical as an accountant to be in a position to understand these numbers. It's not about calculating. You need to understand the meaning behind the numbers. Okay, I think this is good. Okay, I need you to subscribe. Please subscribe to the channel so that you can benefit fully and understand. Invite a lot of people, and we are good to go. Thank you, Styles. Enjoy in China. Invite more. All right, invite more people to this channel. Good time. Good to go. Thank you. Bye bye for now. Okay, Mr. Masaya Shengo.